Kia ora te whānau, my name is Edia and you're watching the Generation Invest YouTube channel providing simplified financial education. So what will you be getting from today's video? Firstly, I want to cover the basics around investing, the share market and simplify some jargon terms. Secondly, I want to show you the most common platforms that Kiwis use to invest here in New Zealand and teach you how to prepare before investing because there's a lot of noise or misconceptions that surrounds investing that you need to avoid. And finally, I want to leave you with a step-by-step guide that many investors use in this space when analyzing companies and their financials. With that being said, my goal from this video, I want to allow you to feel like you have a reasonable level of understanding about the share market. Now, I may not capture everything, so keep me honest. Leave your questions in the comment section below. Let's get it. Starting with, what is the share market or how does it work? Now, very quickly, stocks or shares are the same thing. Shares is just what's commonly used here in New Zealand. Stocks is a term more commonly used in the States. Simply put, a share market is where shares, stocks, or ownership of a company are publicly traded. For example, say I own a coffee shop and after a few years, I want to publicly sell shares within my company. Now, I may choose to do that to raise capital so that I can further grow my business and hopefully down the track, purchase another shop. You'll hear the word capital a lot in investing. Capital is money that you'll use to buy assets and produce goods and services. So in this example, I value my coffee shop at $100. I split my company into 20 shares at $5 per share. Now I would like to retain 75% of ownership and sell 3 shares to investor 1 share to investor 2 and 3. So if you were investor 1, 2 or 3, you will be considered a part owner of the business. Now don't get owner or manager confused. I will still be the largest stake owner of the company and therefore I will continue to run and manage it. Now my coffee shop market cap or market capital is still $100 and now we have 4 owners in my coffee shop. So just imagine that on an extremely larger scale with the current biggest company being Apple holding a market cap of 2.2 trillion. Jeepers. Now my coffee shop will earn a revenue or income, may have some expenses, maybe I have staff so I need to pay wages, pay for coffee beans and operating costs like rates, like the electricity bill or rent, and whatever is left over is then profit. So at this stage the owners will come together, decide what to do with the profit and a portion of that profit may be paid back to the owners, which is called a cash dividend paid into your trade account. Another option for the profit can be to reinvest. So similar to my previous example where I was the sole owner of my coffee shop, I wanted to raise capital to reinvest back into my company to open up another shop. So how do you as an investor or shareholder make money? So as described earlier, firstly there's a dividend. In New Zealand or Australia, companies typically pay this every half year. In the States, generally a cash dividend is paid quarterly or every 3 months. Typically, a share price increases if there's an increase in revenue or the company becomes more profitable. So back to the example, if after 1 year, the business value is $200, there are still only 20 shares in my company and each share has now doubled. This describes my coffee shop's intrinsic value. Intrinsic value is just another word for the true or essential value of something. So buying a share on the share market, you are now a part owner of that company. Now, unlike my coffee shop, your ownership is probably more like a 0.00000000023% ownership. And if the company makes a profit, then you'll make a profit too. That is fundamentally how the stock market works. So now let's take a look at how you can best prepare before you begin to invest. Now this part's important, so please, eyes, listen, please. Please, eyes, please, listen, please. Budget. There is no point investing $5 here or $30 there and then 1 month later you take it out again. Consistency is key. So find a rhythm that suits you and go with it. My investment style is long term. This is not an abs in 2-minute solution, simply because it has been proven by billionaires and average people like you and me. Minimal debt. Interest rates on debts are likely to be higher than the potential growth you'll see from your investment, and you'll be better off saving money on interest that you pay than earning money on interest that you've earned, aka stock price increases. As we move towards the end of part 2, we get to my favorite part, how to invest. Gone are the days where you needed $10,000 or even $1,000 to get you started. Our generation is now spoiled for choice with the amount of platforms to allow us to invest in the share market. Whether you wanted to invest on the NZX or New Zealand Stock Exchange, there's Sharesies. And if you wanted to invest on the US Stock Exchange, there's Sharesies, Hatch, and Stake. If you are new to any of the platforms, let me help you by using my referral code in the description below. But know that I too will benefit from this, so kaore he aha tahi kia au, or no worries. Now, it's important to have a mortgage broker when buying a house or a finance broker to help with personal advice, insurances, and investing. But for a cost-effective solution for someone that only has $50, these online platforms give you a kickstart to reach your investment goals sooner. Now, finally, we come to my step-by-step guide that is commonly used by many investors in this space when analyzing companies and their financials. Step 1. Invest in a company that you are familiar with, or businesses you understand. For example, a pharmaceutical company may not be a field you are familiar with. Therefore, investing in a company like McDonald's, ethics aside, it is easier to understand. Invest in an industry common to your background. For example, if you're a chippy, there's Fletcher Building, or maybe you work in retail, there's Kathmandu or Walmart. Step 2. Invest in a company that has an economic moat, which is a business's ability to have a competitive advantage over its competitors. The most used example of this is Google. It is common for someone to tell you to go Google something. No one tells you to go Bing it or go Yahoo Answers it. Google has a competitive advantage over its competitors. Step 3. Assess management. Understand how they invest. Are they honest? What investment decisions have they made to profit a company? And step 4. Intrinsic value. Know and understand the difference between price and worth. Price is what someone is prepared to pay, and worth is how much something is actually worth or valued at. Calculating intrinsic value can seem quite complex, yet understanding the fundamentals is quite simple. Now, the current climate indicates that we are well and truly in a recession worldwide, and the current market does not portray this. Therefore, finding a company with the share price at a margin of safety is a little bit more difficult, to say the least, and the term overvalued is something that's more commonly used today. Now, that was a quick 4-step process used to consistently outperform the market. If you are already an investor, you may operate as an active, passive, or value investor. Active investing refers to an investment strategy that involves ongoing buying and selling activity by an investor. Active investors purchase investments and continuously monitor their activity to exploit profitable conditions. Passive investing involves less buying and selling and often results in investors buying index funds or other mutual funds and compounding their wealth over a number of years. Value investing is an investment strategy that involves picking stocks that appear to be trading for less than their intrinsic or book value. The best piece of advice that anyone has ever given me was to remove any emotion from all investments. Don't just buy a company because you like them, and understand your level of risk before investing. The mood swings the market can show year round can be overwhelming for some. So don't rush, think long term. Now, you may hear people say the best time to invest is now. What they really mean is the sooner that you prepare to invest, the sooner you can invest, therefore the longer you can hold your investment for, which means the greater your growth or the greater your wealth can be. So hopefully you enjoyed today's video, and maybe now I've created a space for you to mentally, emotionally, and financially start investing. Keep in mind, the stock market is not a get-rich-quick scheme. It's actually a proven way of get-rich-slow journey. So kiss the like button, subscribe for more videos, and I'll see you on the next one. E noho rā.